Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Lukasz de Pourbaix. He's the Executive Director and CIO of Lonsec Investment Solutions. Welcome, Lukasz.
Thanks, Alex. Thanks for having me.
So I thought today we would start with the current situation with markets, and we seem to have a situation where equity prices seem detached from the economic reality that's out there. I guess let's start off with a controversial question. Do investors really need to sort of hold their noses and jump in? Is this new normal that we're experiencing?
It's interesting because we talk about a new normal, but it's fair to say that as we've seen in the current environment, I guess on a whole nother level, but we've had central banks supporting markets for some time, really. Not post the GFC, we've had significant stimulus via quantitative easing. So the current environment, we've seen that ramped up. We've got central banks buying up not just government bonds. We've got them buying investment grade bonds, high yield, significant fiscal backstops, and markets do like liquidity. So that's the tension point at the moment. Is that while certainly the economic news is poor, the key question we're asking ourselves is, well, how much of that is priced into the market, but also to what extent will markets continue, in effect, backing the Fed? Because at the moment, liquidity is very supportive of risk assets, albeit the economic news is poor.
It's interesting when you sort of talk about the Fed, and we've seen the US market continue. And I probably should have prefaced my comment, but it's the US that seems to be driving most of this growth. And it seems that it's this ripple effect globally that the other markets are sort of continuing. Is there sort of some merit to sort of allocating more to the US because that backstop is there and that's the first place to get returns?
Look, I think it depends on your own individual process and how you sort of look at the world. I mean, I think there's a couple of factors you've got to consider. So, when we're sort of looking at things, we're looking at what is liquidity in markets? Absolutely. And liquidity, as I mentioned, the liquidity environment at the moment is very positive, and that's turned around, even within months in terms of markets are flush with liquidity. But on the other hand, you also got to look at valuations. Now, the US market is certainly not at extreme expensive levels, but it's certainly not cheap. So I think when we think about it is also looking at, well, do you pile into an asset that's arguably not cheap? So we've probably would taper that view in terms of just piling into US equities. And I think also it's important to note that the US market, it's been driven by a fairly narrow selection of sectors and stocks, and the tech sector is a good example in this environment. So I think you've got to be not just look at the broad asset class, but really look at what type of exposures within the asset class, whether it's on a stock level or sector level. I think those type of decisions will become increasingly important.
So as we think about you mentioned the FANG stocks obviously being the ones that have been driving a lot of the S&P 500 and the NASDAQ of late, is there just this sort of wisdom of the crowd, I guess you could say, that people all want to hold the same assets? When I speak to asset owners as part of this podcast series and as part of our normal day-to-day, they all talk about buying assets that are got good brand names, their quality management. They talk about dividends. Are we going to see this sort of overvaluation maybe just persist because there's just this very strong belief that you've just got to buy that these particular businesses? Is that going to
I think there's merit in that comment because at the moment, if you look at the current situation, I think people are looking at those businesses that have sustainable balance sheets, those businesses that will be able to potentially survive, those businesses that will continue to exhibit some kind of growth profile. So if you're sort of thinking about that dynamic, then certainly that will sort of gravitate you to certain parts of the market that, call it that quality end of the market, however you want to term it. But so you may see, though, albeit valuations aren't cheap, those parts of the market continue to do well.
Mm-hmm. So let's broaden it out from equities, right? And a portfolio is not just equities. How do you think about portfolio construction now? What are the asset classes that sort of, you think about in terms of compartmentalizing a portfolio for your clients?
Yeah, so we do invest across the full spectrum of asset classes, ranging from equities, bonds, alternative assets, and so forth. So at the moment, some of the areas we've been focusing in on a little bit deeper. One has been into credit markets. And certain elements of the credit market, so things like the loans market. So prior recent events, I mean, some of those markets looked quite expensive, but at the moment we are seeing some attractive pricing opportunities in parts of the credit market, even syndicated loans, for example. So even if you factor in default, a certain level of default rates, those sectors are looking relatively attractive for us. I think also given the fact that yield is going to be challenging, we're seeing dividends, companies defer dividends, cut dividends. So from a risk return perspective, we are looking at some of those markets segments as well. So credit. The other elements that we've been looking at is some of the alternatives. We've always had an exposure to alternatives, and primarily via your multi-asset diversified alternative structure. But more recently, we have been looking at assets such as gold, and we have been making a small allocation to gold across some of our portfolios as well.
Can you give the thesis behind gold? I know a couple of different investors are now starting to suggest it. What's the thinking there?
So there's probably two elements to the gold allocation. One is we know when there's a flight to safety, gold tends to be a store of wealth, and we know that price tends to do pretty well. So in a deflationary environment, as we are arguably now, in an environment where economic news is poor, having some exposure to gold we think is warranted. And then looking further afield as well. So we talked about the massive stimulus we've seen by central banks and fiscal stimulus as well. While no one's thinking about it at the moment, inflation at some point may reappear. And so from that perspective, we think that gold also can act as an inflation hedge if that is a risk that comes to fruition.
Mm-hmm. How much does the foreign exchange sort of considerations play into the portfolio? Because gold obviously is priced predominantly in US dollars. Is that also a foreign exchange bet as well?
Not specifically. We're not sort of using it from a currency perspective, but I think more broadly, just on currency, one of the things we are thinking of is increasing our. At what point do we start increasing our hedged exposure? Most of our exposure to date in global equities has been unhedged, which has worked really well. But we're starting to look at sort of currency valuation more broadly and saying, well, does it make sense to potentially look at introducing some hedged exposure? We're probably not there yet, but we are looking at that a bit more closely. Mm-hmm.
How much does the unlisted space and the illiquidity that sits behind it? Some of these syndicated loans are, they're quite illiquid. How much does that play into the part of building the portfolios?
Yeah, so liquidity is important. I mean, our exposure to illiquid assets within the portfolio is very small. That's partly due to the universe we can invest in. So we're dealing with products in the wholesale space. And so certainly from our perspective, liquidity is very important. And our exposure to illiquid assets is one naturally sort of limited by the universe we have. But it's also a conscious decision where, we think liquidity is important, and particularly in the structures that we invest in, you need to have liquidity.
Mm-hmm. So let's take it back also to sort of the broader portfolio construction. You know, a lot of funds have got this SAA as they build up and they start to build out buckets. You know, how do you guys approach it?
Yeah, so we over the long term, yes, we have an SAA framework, and that's built up. I guess, you know, we're looking at forward-looking capital markets assumptions. We're looking at things like GDP growth, the inflation rate, and obviously, you know, the correlation between assets and risk. I think more of on a medium-term basis, we are looking then more closely at things like valuation. We're looking at things like where are we in the cycle, the economic indicators, policy and liquidity. And then we're also looking at risk measures. So things like, for example, the VIX index and other risk measures to get a sense of shorter term factors. So from a dynamic perspective, they're the key factors we look at. And we're looking at those factors on a sort of 18-month to 3-year view. And they really drive the tilts within the asset allocation for us.
Can you give a bit more context on the dynamic piece to the puzzle? What does that look like? How much would you be willing to move? You know.
Yep. Yeah. So our dynamic asset allocation, we do think that the strategic side is over the long term is going to add the bulk of return to returns. The dynamic for us is really to be able to tilt the portfolios primarily with a view of being able to manage risk within the portfolios. So, you know, in terms of the extent of that, we may take a tilt of, you know, up to about 5% away from the strategic as an example. And we are looking at those three elements. So we start off with valuation. So internally we've got an internal IRR model that we look at in terms of long-term valuations. We look at other valuation metrics as well. And that gives us a sense of, you know, do we think assets are you know, effectively cheap or expensive? But then we also recognize that, you know, valuation is very much a long-term indicator. Valuation, you know, is certainly a 7-year plus type indicator. So assets can be expensive for a long time or cheap for a long time. So we do think you need to overlay that then with some medium-term indicators, and that's where things like policy, you know, at the moment, as we discussed, we're seeing ample liquidity in markets. So what does that look like? What do the economic indicators look like? And then finally, some of those more shorter-term metrics, those risk metrics, what is that environment looking like? And that gives us then, you know, so in practice, what that may mean is, like, for example, if an asset is expensive, but policy is still supportive, then, you know, we may still hold that asset. You know, and that's so there's that interaction between those factors. And so at the moment, more recently, we were coming into the current market environment. We were slightly underweight to risk assets. We're holding more alternatives, but we've neutralised our exposure to equities on the view that there's a lot of economic uncertainty, and no doubt we think there's going to be more bad news to come. Policy at the moment is supportive. Valuations are, while not cheap, are better probably than they were leading into the current environment in some markets. And some of those risk factors have been still elevated in some areas, but have been trending down. So over the sort of 18-month, 3-year view, you know, we're certainly not bullish, but you know, we've neutralised some of that equity exposure.
How comfortable are you in terms, you know, when you talk about measuring risk, and I know a lot of people do their various sensitivity analysis and scenario planning. How comfortable are you that sort of what you can use and the platforms that you can look at and analyze your risk sort of are good for going forward, you know, in this new environment?
Yeah. Look, it's a very good question. You know, it's there's, you know, and as we've seen in the current environment, you can model all you want, but when you get a left field event like a pandemic, there's no risk model's going to save you, right? So I think risk is, you know, for us, it's just trying to, look, what are the possible scenarios from an economic perspective? a policy perspective. But I think it's important just to have a clear process, because I think you're not going to be able to predict these type of things. But if you stick to, what are the key things you believe in from a philosophical perspective, and, in our case, we do think valuation is important. We do think policy and liquidity are important. And those are the things we try to stick to, because, look, there will be left field events, and there's a lot of noise in the markets, particularly in periods like this. So it's sticking to that process. But you look, risks, if you sort of think about most market events, outside of the actual event, usually market, whether it's a pullback of some sort, there's a liquidity element and a leverage element. And I think having a sense of those things is important when you're thinking about risk.
I wanted to pick up on your point about sort of, you talk about valuation, you talk about policy. How much does sentiment, and sort of this broader market, crowd, or this market crowd effect that sort of drives markets affect you? Like how do you think about that piece? I know there's a lot of funds allocate to momentum. That's maybe one way to capture sentiment, but how do you think about that?
So look, momentum's interesting, and a lot of the evidence suggests that momentum's pretty effective. We don't specifically we look at short-term measures. As I mentioned, we look at some of the risk indicators, like VIX and so forth. But we're not basing our decisions on those indicators. But it does give us a sense of, for example, if we're seeing if valuations are okay, policy is positive, and then there's positive momentum, it just gives us, I guess, increased conviction, potentially in a position. But we are not, we're taking that medium-term view. So those shorter-term momentum types of indicators we think are relevant, but we're not sort of basing our decisions on that.
Mm-hmm. How much do you think that your portfolio, will be affected by this current crisis? Right, we came into this crisis with huge concerns about valuations, concerns about big debt overhang, and being the end of the cycle. Actually, the end of the cycle conversation seemed to be going for the last 4 or 5 years and just kept continuing. Yeah. How have you been thinking about sort of whether this crisis now is this end of the cycle, and how do you maybe need to sort of rethink your SAA or rethink even the individual assets that you're allocating to?
Yeah, the whole sort of cycle. You're right. Leading into this, the conversation was we're sort of near the end of the cycle. I think the current environment is certainly accelerated that. I think from our perspective, we are looking at our sort of what are our capital markets assumptions look like going forward. What are those IRRs for the various asset classes? Potentially are they given we've had a pullback in some parts in some markets, do those IRRs look higher potentially in the future? It's so we're going through that exercise at the moment. I think in terms of assets, it's a valid point. So if you think about things like bonds, and quite possibly we might see bond yields go down further as central banks continue to their sort of QE type of program. And so at some point, what do you do with bonds? Do they still have a role to play? We don't think we're there yet. We still think bonds do have a role to play, and they have acted how they're supposed to act when markets have pulled back. But at the same time, we think there will become a point of time. So do things like gold play a greater role, and other alternative assets? I think they're the sort of key questions we're asking ourselves from a portfolio perspective. And I don't think we've got an answer today, but they're things that we're thinking about at the moment.
Let's take the conversation to the income generation piece, right? You talk about bonds, and bonds were historically seen as a very good proportion of income that these portfolios are generating. As you get more and more people moving into the retirement phase of the equation, the search for yield becomes immense. So how does that now change? Where do you go?
No, look, it's a good question, and I think so. We do run a set of portfolios that's focused on that retirement phase of investment, and you said it leading into this that those portfolios had a bias towards Aussie equities, and a large part of that obviously is due to the yield and the franking, which for zero tax paying clients is certainly relevant. Now, if we're sort of factoring in a 30% drop in dividend income for that part of the portfolio. So where do we source yield from? Generally, within those portfolios, we have had a bias away from duration, from govie bonds for some time. So it has had a bias to credit. We are looking at other parts of the credit market, and I mentioned things like syndicated loans, as well as playing a role potentially within that income generation. But I think that the main message that we're saying to clients is even by further diversifying our sources of income, and we think that will sort of assist in delivering income. We do think that certainly for the next 12 months, the expectation that should be set with clients is that income will be lower, and the dividend deferral cuts. Look, our view is that it's a temporary measure. At some point we think that the dividend income will sort of return, but there's no silver bullet in terms of there's no sort of one area where you're going to sort of generate all that income. So there's incremental things that we're doing, looking at different parts of the credit market where we do think there's significant mispricing opportunity, and we'll get a bit of a yield pickup. But the overall message for certainly for the next 12 months is that yield will be potentially lower.
Yeah, look, that part about income is incredibly challenged. The other thing is, do you sort of look at manufacturing income in the sense that you invest in assets that have got that growth, and you can slowly start to pay them, sell down to create an income stream? Is that another option that you guys have looked at?
Yeah, no, absolutely. So, absolutely. So, I mean, in terms of our client base, they will structure things so. With the advisory space, they will also structure the portfolios more broadly in terms of, what we see a common approach is that a lot of clients will have a cash reserve which they're using to draw down excess income they may require. So there are certain structures in place already for a lot of clients that are used by a lot of advisors to assist in periods like this where you're not having necessarily to draw down on your growth assets, and you've got that cash reserve. So that's a commonly used strategy that's being adopted. In terms of income, just more specific again to sort of asset classes, we also do invest in some structures that can generate income through options as well. And in the recent environment, that's sort of worked pretty well as well. So it's really for us, it's about diversifying your income sources across a large pool of assets, not just one source. And then, as you say, from a sort, how you draw down that income using things like potentially having excess cash there for periods like this, where you've got that cash reserve to meet those income gaps.
Yeah, you talked there about sort of the need for income, and I guess that's a really big part of it. Some of the issues that you sort of just raised there in terms of income coming from the syndicated loans being an interesting space. Is there a risk of potentially taking additional risk to now generate that income?
Absolutely. I mean, it's also important to note where you're funding that from. So we've been actually looking at that as funding from equities, rather than sort of the fixed income part of the portfolio. Because to your point, there is a high equity beta associated with some of these assets. So it's important to understand, if you are going into these assets, where are you funding those from? And certainly from our perspective, it'd be funded more from that sort of equities part of the portfolio, because of the high risk part associated with those type of structures.
So thinking about the portfolio as it sits today, what a model portfolio looks like, how do you split it up geographically around the world? Do you have a sort of a preference for DM or for emerging markets? Can you give a bit more color about sort of what that looks like?
Yeah. So at the moment, if you look at it from a dynamic perspective, we have had a tilt towards EM. DM still makes up a significant portion, obviously, of the portfolios. And leading into this environment, the rationale for that was that it was probably one of the few parts of the market in terms of asset classes where we did see a valuation opportunity, albeit we know it's high risk, but we felt that the risk reward was warranted. Again, if you're taking that sort of 3-year view, now we've maintained that. What we've seen though is that sort of valuation premium come back a bit in EM. But we continue to hold that for the moment. But we are constantly reviewing it. So we still continue to have a slight bias to EM.
I really wanted to touch on these last couple of months in the sense of working with the advised space. You'll be receiving a lot of questions from that part of the market. I'm just curious on the communications that you've been putting out there. What are the questions you've been receiving? These types of environments make people very jittery. What does that communication process look like for you?
So, look, in such environments, you need to communicate, and you need to communicate more. So, we've been communicating in a variety, both in written form. We've been doing a lot more webinars with clients, individual calls to individual advisors. So certainly the communications increased. I think the key messages that we've been going out with is in such environments, it's important to refocus back in on what is your investment philosophy, because there is a lot of noise, and when there's a lot of noise, the risk is that you can be very reactive. So it's been a message of refocus, understand what your long-term objectives are, understand what is your investment philosophy, and really focusing on that. Pleasingly, what I would say is in speaking to a lot of financial advisors, while there's been a thirst for knowledge and questions, the sense I get from speaking to advisors is that their clients, certainly compared to the GFC, appear to be calmer, and certainly advisors that have been through this have been very measured in their response, which is great, which is really interesting, and it's really pleasing to see, because I think a lot of the advisors have educated their clients really well. We've had great markets for over 10 years until now. It's just the reality. We've had great returns. And so that education process, when things are good and without being able to predict what's going to happen, but knowing that, markets can go the other way, I think that's sort of paid dividends. And I really get a sense that this time around, even though it's a much, in my eyes, a bigger event than the GFC, it appears that from an advisor perspective, they've done a really good job in educating their clients and helping them navigate through these periods, which has meant that they haven't just run for the hills and gone to cash. And so it does show the value of good advice.
Oh, look, it's undoubtable that advice is critical for people to understand what they're doing before making decisions. I was curious to sort of throw a facetious style question in there, and how much do you think this buy the dip mentality plays into some of the thinking of clients as they think, okay, I'll next crisis I'll go all in, I'll make sure I take advantage of it. Is that part of what we're seeing now, and why we're seeing such a recovery?
I think there's an element of that. I look, there's there's a whole range of, I guess, clients out there, and just to give you a real life example, I was speaking to an advisor yesterday, and their client base was very much that retiree client base. And we're having this exact discussion saying, well, how are your clients? How are they? Are they okay? And so forth. And a couple of things to note is, one is, to your point, there's actually a couple, and this is the retirees that have been looking to get into markets, which is interesting. So you are seeing a bit of that behaviour. I think anyone that went through the GFC probably said, well, if the markets pull back again like that, I'll probably go in. And so we are seeing a little bit of that. There is caution, though. I don't think we've seen people go in hell for leather, but I think you're seeing a bit of that activity. I think it's real. That's from the ground. We are hearing of that increasingly.
One of the last questions here to you is, we've seen markets recover. The stability is sort of there as liquidity's been injected. What would make you sort of wake up in sweats that things have now changed again?
Yeah. Look, there's a lot of sort of X factors. I mean, the US China, I guess, I don't know what you want to call it, argument. Look, and it's not a new thing. The last 12 months with we saw the trade wars and we saw that sort of rhetoric come through. This is obviously on a higher level. So look, there is, to what degree that sort of potentially gets out of control. I mean, I think that's always sort of something that you've got to be cognizant of and concerned about. But the big one is obviously the virus itself. There's still a lot of unknowns, and we are seeing economies open up, which is positive, and we don't know to the extent that we'll see economies kick back into action. But if we were to see people talk about a second wave and virus, and if we saw things regress and economies have to lock down, I think that's the thing that sort of is not an ideal scenario, and certainly we would see markets pull back. But on the flip side, this is increasingly diversifying your portfolio at the moment. We talked about things like having a bit of that alternatives, having a bit of that gold exposure there, having looking at that quality end of the market in terms of from a stock perspective. I mean, all of those things certainly aren't going to save you, but will assist. So being prepared that, yes, we're seeing a bit of we've seen markets recover, but we can also see a pullback, and so increasing that diversification is important.
Well, that's a fantastic conversation. Thank you very much for your time, Lucas.
Thank you, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.